atmospheric street noise subtly playing in the background. You're standing at a crowded Mumbai street stall. You order a cup of chai, pull out your phone, and scan this weathered QR code to pay 10 rupees. It takes about 3 seconds. A quick beep confirms the transfer, and you walk away. For you and the vendor, the experience is frictionless. But beneath that ease, banking servers are lighting up. Every single day, India's digital payment network must route over 66 crore of these individual transactions. That effortless payment for tea is adding extreme pressure to a national infrastructure, currently bearing the weight of a massive digital economy, all without charging the users a single rupee. To understand the scale at play, in June of 2025 alone, the system processed over 18.4 billion individual transfers, yet neither you nor the tea vendor pay a fee for this service. This is due to a policy called Zero MDR, or Merchant Discount Rate. The digital rails are entirely free to use. Authentication requests consume electricity and server capacity every millisecond. When the transaction fee is zero, the cost to run the system doesn't simply disappear, it accumulates. If the network doesn't charge for the actual transfer, the physical servers are essentially running on borrowed time. India has built the largest real-time payment system on the planet, but maintaining a free utility of this size is a precarious arrangement, risking a breakdown if it doesn't find a way to generate its own revenue. This chart reveals the network's strain. Transaction volume is skyrocketing, while the value moved stays flat. Merchant payments make up 63% of all network activity, but account for just 29% of the total wealth moved. 86% of these merchant transfers are for amounts under 500 rupees. It's urban consumers buying daily groceries, paying for fast food, and mobile recharges. India's $7.6 billion quick commerce sector depends entirely on this zero-cost infrastructure. Platforms like Blinkit and Zepto rely on these subsidized payments to make a 10-minute delivery of a single loaf of bread economically viable. The servers are working overtime to process billions of low-value consumer habits, creating immense operational friction without moving significant capital. This pie chart illustrates the flip side of the equation. Just 4% of merchant transactions are above 2,000 rupees, but that tiny slice holds 66% of the total monetary value on the network. To process those few high-value transfers, a small group of legacy banks must absorb the server costs for billions of free, low-value requests. This data table displays the monthly per capita transaction rankings by state. Usage is intensely concentrated in highly urbanized regions like Delhi and Chandigarh. But scanning down the rows, heavily populated, lower-income states like Bihar and Uttar Pradesh trail significantly behind. While the interface has successfully reached across the country, its integration into the deeper economic lives of most citizens remains shallow. The infrastructure has reached the limits of what it can accomplish as a basic payment pipe, moving money from point A to point B. To offset the massive server costs of the tea stall and quick commerce, the network must capture missing high-value categories, like public transit and education. The network must now mature into a comprehensive financial ecosystem. This transition requires connecting these microtransactions to complex credit, insurance, and pension notes. By tracking the behavioral data of a 10-rupee daily purchase, fintech companies can build a digital footprint. That data allows them to underwrite insurance and offer flexible credit lines to populations that were previously unbanked. Over the last 10 years, these digital rails rewrote the rules of Indian commerce. Now, the survival of that infrastructure hinges on whether it can turn raw volume into deep, self-sustaining financial inclusion.
We at Kubear are trying to bring forward normal money habits of India and cover all around it.